Well, good morning, everybody, and a warm welcome to our first quarter trading update. Thanks for joining us at this slightly later time than usual. We'll be back to 8 a.m. UK time from next quarter. I'll begin with the market context and a brief review of our growth performance. Andrew will then take us through the categories and the regions, and I will conclude with an update on three big initiatives: net revenue management, new functional models, which is the next stage in our organisational transformation, and zero-based budgeting. Before we go further, let me draw your attention to the usual disclaimer regarding forward-looking statements and non-GAAP measures. So let's get going. We've had a good start to the year, with another quarter of consistent and competitive growth ahead of our markets. In January, we said that we were prepared for the business environment to become even more challenging, and that has proved to be the case. In Europe, markets continue to decline with stable volumes but falling prices, while in North America, growth in our categories has eased back to only around 1%. In Brazil and Argentina, market volumes are contracting as consumers struggle with rising unemployment and the high local inflation brought on by currency adjustment. Falling real wages are also holding back demand in commodity exporting countries like Russia, South Africa, and in the Gulf. The economies in China, India, and Southeast Asia are holding up better, but even here, growth in consumer demand remains relatively subdued against historic trend levels. Looking in aggregate and taking a broad global average, market volumes in our categories are flat and pricing is around historic norms. But within these aggregates, we continue to see some strongly divergent trends. Many consumers are uptrading to higher value items for at least part of their daily or weekly shop. While at the same time, those consumers are looking to economize by downtrading for other purchases. In a number of countries, especially in Latin America, there is strong price inflation, whilst elsewhere, price growth is relatively low, or as in Europe, there is price deflation. Now, despite this very challenging market backdrop, it is clear that it is still possible to grow through a broad portfolio, sustained investments in brands, and locally relevant innovation. In fact, we are growing and winning share in all four of our categories. Our first quarter underlying sales growth of 4.7% was towards the upper end of the 3 to 5% range we have guided to for the year. The pickup in growth versus last year came mainly in volume, which was up 2.6%. Price of 2% continues at around the level we have seen for the last couple of years, albeit with differences by region, which Andrew is going to come back to in a few minutes. While underlying sales grew 4.7%, turnover was down 2% at €12.5 billion. M&A added 0.7%, mainly through the acquisitions of the prestige personal care brands. These are performing well. Currency translation reduced sales by 7.1%. About half of this comes from the weakening of the Brazilian real and the step devaluation in Argentina. For the year as a whole, if exchange rates were to stay as they are today, the currency translation headwind would be between 5 and 6 percentage points on both turnover and EPS. Now let me hand you over to Andrew to take us through the categories and the regions.
Thank you, Graeme. And as usual, we'll start with our largest category, personal care. Here, our priorities are to continue growing the core while building more premium segments. Underlying sales grew 5.8%, mostly from volume. This is back to being ahead of the Unilever average, in line with our strategy. Growth and premiumisation are being driven by innovation. In the US, the new dry spray format is going from strength to strength, with the launch of another 10 variants in the first quarter. They continue to drive overall category growth, with more and more consumers switching to this more appealing and higher margin segment, and they're helping us further widen our market leadership. At the same time, we're rolling out a range of antibacterial deodorants under the Rexona brand, offering 10 times odor protection. After good results in Latin America, we've just introduced them to 15 new markets, with another 15 planned for the second quarter. Axe has become a major global upgrade. The new campaign, Find Your Magic, appeals to a more mature and more sophisticated audience and broadens the emphasis across a range of male grooming products. So, for the men listening, if you haven't seen the advertising or tried the new products that are just coming out, I encourage you to do so, even if, like me, you're slightly older and thought that your Axe or Lynx days were behind you. In hair, we've launched a new system which is literally revolutionary. Tresemme Volume is a reversed two-step process with the conditioner applied first and the shampoo applied in the second step. This leaves the hair residue-free, which means it's lighter and has more volume. Turning to foods, our priority is to accelerate growth while maintaining the strong margins and cash flow that this category generates. In the first quarter, underlying sales grew by 1.9%, all from price. Savoury continues to grow well, driven by increased consumption in emerging markets and innovation that combines global scale in branding and technology with local relevance, like the meal makers in Southeast Asia that we spoke about last quarter, or a new range of Knorr masala seasoning mixes, shown here, that we've just launched in India, offering restaurant-quality taste in innovative Ziploc packs. We're also seeing good traction across the foods portfolio for products that meet the growing demand for authentic, fresh, natural, and sustainably sourced products. Knorr meal makers with 100% natural ingredients are growing well in Germany, and Hellmann's is gaining share with a new Real campaign and launches in the US of an organic range and a new vegan alternative under the banner of Carefully Crafted. In the UK, we are repositioning Flora spreads as powered by plants, emphasising that they are made from natural plant oils and not from animal-sourced fats. We've also introduced a dairy-free variant for vegan and lactose-intolerant consumers. However, the spreads market continued to decline in both Europe and North America, dragging on the overall foods performance. In home care, our priorities are to improve profitability in laundry and to scale up household care. Our innovation funnel is focused on uptrading consumers to more value-added and thus margin-accretive products. The good news is that as well as improving margin, this focus is helping to sustain strong growth and share gain against both global and local competition. Underlying sales grew 7%, mostly from volume. Omo with wash boosters was introduced into a further 8 countries in the first quarter, taking the total markets reached so far to 18. The range of Omo specialist pre-treaters and stain removers, already successful in Brazil, is now being launched across Latin America. And we're creating premium tiers for our established brands, like Comfort Intense fabric conditioners, which combine fragrance and sustainability benefits in a super-concentrated formulation, and Surf Sensations, which we're launching now, the first ever fabric cleaner with perfume-like fragrance. Meanwhile, in household care, Cif and Domestos continue to build well, and we're taking Sunlight dishwash to new countries, most recently with a launch in China exclusively through e-commerce. Turning to refreshment, our priorities are to improve the margins and cash flows in ice cream and to grow faster in tea by repositioning the business to on-trend segments. Underlying sales grew 3.8%, equally split between volume and price. Growth is being driven by our premium brands and variants. In ice cream, Ben & Jerry's shows the power of combining a purpose-led brand with innovations like the recent launches of Witch sandwiches for snacking and a non-dairy ice cream made from almond milk. Magnum's new Release the Beast campaign is giving strong support to the Magnum Double range, and Breyers Gelato and Carte d'Or premium desserts are benefiting from new recipes like Tarte au Citron Meringue and Rainforest Alliance Vanilla. In tea, growth is driven by specialty teas like T2 and by green teas, which have helped to restore our overall leadership position in India. The traditional black tea market remains highly competitive, with deep promotional discounting, particularly in the UK. On the other hand, we're seeing double-digit growth in ready-to-drink tea, both with Lipton and the Pure Leaf brand. Pure Leaf is another good example of a brand appealing to the trend for naturalness and is up by more than 30%. As a reminder, the ready-to-drink results are included in the JV line, and we do not count it in our underlying sales growth measure. That completes the category review. Now turning to the regions. Growth is driven by emerging markets, up 8.3%, including 3.7% from volume. Our largest region, Asia AMET RUB, represents around 3/4 of our emerging markets turnover and grew 5%, nearly all from volume. Pricing here is less than 1% on average, the lowest it's been for 5 years. Momentum in Southeast Asia has improved, and we are growing strongly in e-commerce in China, which has nearly doubled over the last year, largely through our partnerships with Alibaba and JD.com. Our business in Russia moved back into positive volume growth, although market conditions there remain fragile. Volumes in South Africa declined as disposable incomes have been squeezed by the weaker currency. But elsewhere in Africa, we've seen good growth as we implement the lever edge distribution system, already proven from Southeast Asia. Latin America, which represents 25% of our emerging markets, grew nearly 18%. Much of this came from pricing to recover devaluation-led cost increases, but importantly, volumes also grew by 2.4%, albeit against a somewhat easy comparator. In Brazil and Argentina, consumers have cut down on purchases and are downtrading in response to the high level of price inflation. We've been able to mitigate this and gain market share with sustained investment in our brands, strong execution, and by using our full portfolio, which includes local value brands. We are cautious on Latin America volumes for the balance of the year, as market conditions are likely to deteriorate further before they improve. That said, we've grown strongly in Chile, Colombia, Mexico, and Central America in the first quarter. In North America, underlying sales were flat. We had good growth and share gains in deodorants and ice cream, but this was offset by the continued decline of the spreads market and our exit from some private label and export business. As we signalled in January, there has been a further modest reduction in trade stocks here. In Europe, underlying sales declined by 0.6%. Volumes grew by 1.8%, with a little help from the slightly earlier Easter. Volume growth was broad-based across countries, but more than offset by accelerating price deflation. Prices were down across almost all countries, and particularly so in the UK. In part, this comes from benign commodity costs, but also reflects the challenging retail environment. And with that, I'll hand back to Graeme.
Thank you, Andrew. At our investor event a few months ago, we set out 3 key initiatives to underpin sustained value creation in the coming years. Now, while these are still in their very early stages, I thought it would be helpful to give you a brief update on each of them. The first is net revenue management. The essence of NRM is understanding consumers' perception of product value and aligning product price, placement, and availability. I've called this before the art of pricing, but we could also call it part of the brilliant basics of consumer goods. And to some extent, we're in catch-up mode with the leading practitioners here, for example, in the drinks industry. On the chart, you can see a very simple real-life example using Bianti, or whiteness laundry brand, in Brazil. In this case, we have increased the relative price of our 1 kg and 3 kg packs and reduced slightly the price of the 2 kg pack. Since making the change, all 3 packs have gained share. Of course, we've simplified this example to illustrate the point, and in practice, there is a very detailed set of analyses across all SKUs and multiple channels. We look at key price points that trigger purchase and the drivers of actual and perceived consumer value. This results in differentiated pricing and promotional plans for each pack and channel. The program has been rolled out globally in waves, and by the end of 2016, we're looking to have covered 40% of our turnover with NRM. We typically aim to realise around 1% incremental turnover, either in price or volume, in the priority country or category cell. We expect NRM to help to underpin consistent share gain and underlying sales growth in the 3 to 5% range, despite the challenging retail and competitive environment. The second key initiative is the organisational change, which we referred to at our investor event as new functional models. Unilever's solid performance in recent years has been made possible by a continual evolution of our organisation, from one Unilever to the 8 clusters and 4 categories, to the integration of R&D into the category teams. This has served us well, but the world around us continues to change very rapidly. It is becoming more interconnected and more global in many ways. Trends are gaining global scale and innovations with new technologies are being rolled out faster than ever before. But at the same time, consumers are more than ever identifying with local cultures and looking for brands and products that meet their individual needs. We see this reflected in the fragmentation of media, the diversity of consumer preferences, and the growth of many local competitors. And new business models are emerging with speed. The rapid growth of different e-commerce models in the UK, France, and China is an obvious example of this. So we are taking the next steps to evolve our own organisation to make sure it is well adapted to this changing environment. The fundamental building blocks of 4 global categories and 8 clusters of countries will not change. But we will change the organisation within this framework to make it faster, simpler, more consumer and customer-centric, and ready for the connected world. We're currently in the design phase, which is being led by Peter Terkova, who many of you will know already from your visits to the Philippines and Singapore last year. We will start to implement the design changes during the second half of this year. We'll talk more about these in due course, but for now, the key points to note are that there will be a stronger, more impactful, and more directly connected global organisation to help speed up the adoption of global ideas and technologies. But at the same time, the organisation will be more market-facing, with more executional resource deployed locally in countries. There will be fewer layers and less resource in regional hubs and head offices. This will allow clearer accountability and responsibility, faster decisions and action, as well as lower cost. The third initiative is our zero-based budgeting programme. This runs in parallel with the organisational work and complements it. The scope of ZBB is our spend on overheads and marketing other than salaries. The first step, which we will complete by the end of this month, is to give much greater visibility to exactly what is being spent and by whom. During this step, we have defined business leaders responsible for each one of 18 cost segments, which cover most of the total spend. The second step is value targeting. This means agreeing savings with each of the individual budget holders and locking them into our plans. We'll start with the 22 largest markets and with the corporate locations between now and July, and then move on to the next 60 countries in the remainder of the year. The third step of the process is implementation and control. This involves regular reviews to ensure that the savings are delivered. In combination, we expect ZBB and new functional models to deliver at least €1 billion of savings by 2018, with the benefits realised progressively through the second half of this year and during the course of 2007. It's worth remembering that this follows many years of continuous improvement programmes. Programmes like Return on Marketing Investment that realised efficiencies in advertising production, or Project Half that has helped bring our overheads level very close to conventional benchmarks. So these new initiatives, while significant, represent the latest wave of savings. We will, as before, take some to margin, while some will be reinvested behind growth opportunities. We see them helping to underpin the competitive growth and steady year-on-year margin improvement that we have been achieving and expect to sustain. And as a reminder, this includes continuing to absorb the associated restructuring costs. To conclude then, the first quarter represents a good, solid start to the year. We expect market conditions to remain volatile and hence challenging for a while yet. However, we remain confident in the longer-term prospects for emerging markets as currencies stabilise and wages catch up with price inflation. We have a lot of experience in these cycles, and we know how to manage through volatility and come out even stronger. The growth comparators do get tougher in the second half of the year, but we remain confident of delivering against our objectives, which remain unchanged. These are volume growth ahead of our markets. We expect this to translate into underlying sales growth in the range of 3 to 5%, steady and sustainable margin improvement, and strong cash flow. These underpin a sustainable, attractive and growing dividend, and we've today announced that this will again increase by 6%. Finally, before we move to Q&A, I'd like to thank those investors who took part in the recent survey we conducted. We asked for perspectives on investment horizons, quarterly reporting and sustainability, and we were reassured by the results. I won't go through them now, but they're on unilever.com, so you can see them there. One point that was very clear was an overwhelming level of support for us to continue with quarterly trading updates in their current form, so it's nice to know that what we do is appreciated. And with that, let's open the line to your questions.
Thank you, Graeme. And as a reminder, if you want to ask a question, please press star 1. If you wish to cancel your question, press star 2. If you're listening to the conference call on a speakerphone, please use the handset while asking your questions. And finally, please keep your questions to a maximum of 2. So, our first question is from James Targett of Berenberg.
Good morning, everyone. 2 questions from me. Firstly, just on the UK business, you mentioned there was some weaker pricing, and I think personal care in particular. Are there any other areas which were driving the slowdown in the UK in the first quarter? And maybe you could just give some colour on the magnitude of the sales decline there. And then secondly, on the new functional models you highlighted, could you just quickly recap maybe the time frame for implementation and initial benefits? And should we think about this more as being a revenue-driven project or cost-driven in terms of the benefits? Thanks.
Hi, James. Good morning. So first of all, in the UK, the market was particularly tough as an environment. But in Q1, we did see good volume growth and some volume share gains, but that was all offset by price deflation. I don't want to go specifically based on one quarter into details of the UK's performance, but it's a continuation of a very, very competitive marketplace across all categories. You're aware of the consumer changes in the UK, very value conscious, continued growth of discounters, but above all, very competitive and a high level of promotional intensity, which was particularly sharp in the first quarter. On your question on new functional models and the implementation of it, as I said in the presentation there, we are currently in the design phase. Peter Takova has set up an organisational transformation office, and he will be working on the detail with our categories, with the 4 categories, on principally an integrated marketing design that will work not for the short term, very much what takes us into the next 5 to 10 years of growth. Very much focused on growth, very much focused on being more global and more local, and being able to be more agile, sharper translation of local insight into global plans, being faster and being more connected to the consumer at a time when the consumer is fundamentally much, much more connected through digital and through channels, etc.
Great, thank you.
Right. Our next question is from Warren Ackerman of Societe Generale. Warren, please go ahead.
Good morning, Graeme. Andrew, Warren here at Soc Gen. 2 questions as well. The first one is on pricing. I think if my calculation is right, ex-LATAM pricing overall was negative in the quarter. So how much of the 15% pricing in LATAM was hyperinflation countries versus, say, Brazil and Mexico? And Graeme, what's your view on pricing going forward? Do you think the recent strong rebound in EM currencies means that LATAM pricing decelerates from here? And then secondly, on China, can you say what the growth was in the quarter? I think you say in the statement all of the growth is online. Would you say that, what would you say the e-commerce market is growing at overall in China versus the modern trade? And do you feel you and your peers have been maybe behind the curve on how rapidly the market has shifted to online? Thank you.
Hi, Warren. Good morning. First of all, on pricing, your math is correct. If you take the pricing growth of 2% that we had in the first quarter and you take the Latin American element of that out, it's slightly negative overall. But I do want to emphasise the very, very varied landscape with regard to pricing around the world. So just take emerging markets. Let's take Latin America, which is 25% of our emerging markets. That's the case. None of the markets are hyperinflationary, by the way, but we are seeing very, very strong price increases. We took price increases of 10%, for example, in Brazil. And as we expected, we're now seeing volumes come off. A very challenged consumer, a fair bit of down trading. The good news is that in our second and third tier brands, we're continuing to hold on to the consumer within our categories. And we're continuing to innovate on those markets, Dove Baby and laundry, auxiliaries, etc. So the fundamentals are still there. And as you're well aware, we've got a lot of experience in handling these markets and handling this type of pricing volatility. And over the long term, tend to come out that little bit stronger. Just to go to the other 75% of our emerging markets, and let's take South Asia and Southeast Asia as examples. In that group, as Andrew said, I think, in the presentation, we're seeing price growth of only around 1%, which is the lowest it's been in 5 years. And that's where we expect to see things get back to a normalisation over time and as we go through the course of the year. Turning to pricing outlook overall, we think it will continue to be negative in Europe. We think we'll probably be sort of flattish to perhaps down in North America. It'll continue to be high in Latin America. And we're below the historic average, as I said, in Africa, Asia and Turkey, but we expect that to start to normalise. Andrew?
Yes, the second question on China. Should I take that?
Yeah, go on.
So on China, in the first quarter, we had mid-single-digit growth, all from volume. That is, as you say, being strongly driven by e-commerce. The market for e-commerce is growing around 50%. We're growing substantially ahead of that, around 80%. Currently, around 7% of our business is in e-commerce. It could well be 10% by the end of the year. That's what we're aiming for. I think by the nature of our categories, yes, we probably were a little behind some others in developing our e-commerce capabilities. We now have more than 100 people there, so catching up very rapidly. And the partnerships with Alibaba and our relationship with JD.com that we mentioned are helping that.
Thank you, guys.
Thanks, Warren.
Thanks. The next question is from Harold Thompson of Deutsche Bank.
Good morning, everyone. Just two questions. On your net revenue management, just want to make sure I heard properly what you said. You're saying that you expect to cover 40% of your turnover by year end, and you typically see a 1% uplift in value or volume contribution from that. So do you expect that effectively that program to benefit or boost your growth for possibly 2 years and then roll over, or do you expect that to be an ongoing benefit for the group medium to long term? And my second question, slightly related to what's already been discussed on pricing. You said that Russia, volume-wise, was kind of slightly better or back to positive growth. Is that basically a function of the price now having rolled over and therefore the volume is recovering a bit, or is the volume simply doing better on ongoing high pricing? Thank you.
Morning, Harold. On NRM, we've set ourselves an objective of covering 40% of our turnover, but it's very much done at a category in-country cell level. The point I'd emphasise about net revenue management, although it's a global programme with various pillars and various philosophies and types of analysis that happens relatively consistently, it's essentially an on-the-ground, in-country, by-cell local programme. And what happens when you've run the analysis and done the thinking, done the facilitation, is you end up with a series of potential actions that get taken. And then there's a decision to be made about whether those actions are implemented or not. So it's not automatic, and I don't want to imply that 40% of our turnover will have a 1% uplift going forward. That tends to be the size of the opportunity that we see across price and volume, but it phases in over time. And I should also point out that when you do the analysis, you tend to come up with a good list of ideas, and then whilst that gets embedded, in order to continue that, you have to refill the hopper with new analysis, new insight on channels, new insight on value opportunities that exist. So it's not a mathematical science, it's much more a capability that's being reintroduced back into the business with a lot more granularity. It's very close, actually, to what we're talking about with global and local. A combination of global working with categories on new packs, for example, new sizes, new price positions, but the insights tend to be extremely local. So it's a good example of global and local. Your question on Russia volume, yes, Russian volume came back after a strong amount of pricing that was taken before. The improved performance, I think it's largely down to sustained brand and marketing investment. We've continued to invest in the Russian marketplace. We've been particularly strong in personal care. As you know, our portfolio, which I think now is 50% personal care in Russia with strong local brands, has benefited us. So I think that's where the volume comes from. I'll ask Andrew if he's got any other points
just to say that it was characterised, Russia, really by the very sharp currency volatility that we had through the course of last year, and of course that continues. So we took a lot of pricing fairly early on last year, and we saw some significantly negative volumes. We've since then made adjustments. The currency's moved back a little bit. We've made adjustments to price positions across our portfolio, including using our local brands And that has certainly helped us move back into volume growth, and particularly strong growth in personal care. But we do remain cautious. It does remain a fragile market.
And Andrew, would you say in other markets where you've seen very big price increases, kind of similar patterns would probably repeat themselves, as currency stabilise, pricing rolls over, that volumes just gradually improves in those markets?
I wouldn't like to draw specific conclusions about Russia based on past experience elsewhere. I think, as I say, it remains a fairly volatile and fragile market. We would obviously look to see those volume growths continue, but I think it's early days yet. So our next question is from Martin Debout at Jefferies. Martin, please go ahead.
Yeah, morning, everybody. I want to come back to the three core change programs. And I mean, first of all, I think it's very impressive what you're doing there. But my question is around implementation risk and organizational workload and how you're managing that. I mean, I guess if I'm a sort of middle-level marketing manager of Vietnam or somewhere, I'm being asked to rework my pricing and promotional plans while my role's being redefined, and suddenly I'm being asked to pay for my own photocopying by some sort of ZBB guy. So it seems like if it's not well managed, it's a recipe for organizational distraction. So I just value, Graeme, probably your take on that and how confident you are that you can manage these three big programs while not taking your eye off the growth and margin ball, I guess.
Well, morning, Martin. I mean, you make a very good point, of course. The question of organisational capacity and sustaining our consistent delivery and the momentum that we have in challenging markets has to remain at the absolute fore. Couple of comments. First of all, the very reason why in the new functional models, the organisational transformation, we've put Peter into a very, very key role centrally is to do exactly that. He's there to run air traffic control. He's there to make sure that we're integrated in the way we think about things, to make sure that the end-to-end alignment of the business through R&D, supply chain, through the marketing organisation, into the sales organisation with the functions of finance and HR, that the whole thing is integrated and makes sense and is sequenced in a way that is proper. And importantly, there's a lot that doesn't change. As we said earlier, the 8x4 structure doesn't change. The fact that we manage delivery of performance on a geographic level doesn't change. The way in which we target the business doesn't change. So there's a lot that doesn't change in addition to making this more integrated organisation come together. On NRM, I touched on it a little bit, Martin, in the presentation. There's an element of back to basics and relearning what we already knew around net revenue management. If you are, as you said, the brand manager in Vietnam, you're probably thinking, well, this is a sort of reiteration on the basic principles of good 6P marketing. And there's nothing particularly new about net revenue management. It's more a re-energization and a refocus of the organisation on the fundamentals of channel architecture, pricing, similarly with core of the core, as we call it, looking at penetration and distribution, staying on the fundamentals and brilliant basics. So that's not so much a change as a refreshment, if you like. And ZBB, I just want to emphasise, we talk a bit about our 4G version of ZBB, which isn't a play on words. It is about our 4G growth model, which we've talked to you about several times before. But why do we think ZBB is going to be a particularly good cultural fit in the business, and why it will be welcomed and energise the company? First of all, it's very data-driven and analytical, and they're key Unilever competencies. We like that sort of thing. It's about eliminating waste. Again, a good fit. We don't like waste. We like to be more effective in what we do. It moves away from incrementals and moves to a more absolute assessment of where we spend our cost. And by opening up brand and marketing investment in addition to overheads, I think that's liberating, especially when there are so many changes happening at the consumer level. And finally, and most importantly, I think, having highly respected operational business leaders, typically the heads of large countries, responsible for the insights, responsible for the strategic decisions we make around cost segments, I think will mean that it creates a lot of energy in the organisation, in addition to being a major change programme. So you're right in your assessment. It's a lot of change, but we have to make sure that we don't take our eye off the ball. That's job one in sequencing all of this.
It's very helpful and interesting. Thank you.
Thank you.
Good. So our next question is from Celine Pannuti from JP Morgan.
Yes, good morning. My first question is on North America. Can you share the sellout with us? And can you as well be a bit more explicit on your performance in terms of your HPC versus food in that market, and how your market share is tracking? And in fact, can we get the margarine growth rate for, in fact, US and Europe, since we are at it? My second question is on your sequencing of the different program you mentioned, and you mentioned that you are going to absorb the cost as you go along. I just would like to understand whether the costs are going to be laid bare first and then we get the saving, or whether there's a bit of a matching between the two. And in that, is there anything we should flag on H1 versus H2 margin? Thank you.
Morning, Celine. I'll take North America, and I'll let Andrew have a bit of a think about the sequencing of costs versus benefits for the programs, if I may. First of all, on your question about sellout, we do continue to see a little bit of trade destocking in North America. Sellout continues about 2%. Our sell-in is about flat, so that's our main litmus test of the impact that exists there. To get into the balance between what's winning and what isn't so much, rather than HPC and foods. In personal care, we're continuing to see share gain driven by deos and hair, but we're down in skin and oral. And overall share gain in North America has been driven by refreshments and PC. Foods is declining a little bit, as you said, driven by spreads. I don't want to get into the detail on a quarterly update of where we are with spreads by geography. That's probably too high a level of detail. Andrew?
Yes, in terms of the operating margin development, we're not guiding on the phasing of margin development, but you should, of course, expect that we are expecting to see the first benefits from zero-based budgeting from the second half of this year onwards. New functional models will progressively start as we implement to deliver some savings as well. It's worth remembering that those savings are to some extent just the next wave, refilling the hopper, if you like, of savings programs. We've delivered strong savings already. So we've already been incurring restructuring costs. We've been already having savings. But I think the level of restructuring costs will be a little bit higher for a little while, but equally the savings may be as well. So we're frankly looking for this to continue to deliver the sort of margin improvement that we've been delivering for the last 3 years, which is 30 to 40 basis points. So that's the sort of margin improvement I think you should assume, including the absorption of restructuring costs associated with these programs.
Thank you.
Thanks, Celine.
Thanks. And the next question is from Alain Oberhuber of MainFirst. Alain, go ahead.
Yes, good morning. Good morning, gentlemen. Alain Oberhuber, MainFirst. I have two questions. The first is regarding the spreads. Now it's getting pretty volatile, positive, negative. Could you give us a little bit an outlook what you expect for the business, when we could expect a bottoming out for your specific spreads business or for the category itself? And secondly, coming back to Celine's questions regarding the margins. So could we expect in H1 slightly lower margins than previously expected because of the more investments we see, in particular with ZBB?
Morning, Alain. Let me take the second one first, actually, just build on what Andrew said in response to Celine's question as it's fresh in the memory. No, we don't expect that the investment phase behind ZBB in the first half will cause any different phasing of margin delivery. I think, as Andrew said, historical rate of 30 to 40 basis points is what we'd seek to maintain, with many moving parts within that as we realise savings, as we make choices about where we invest those savings. It could be behind growth and increasingly competitive margins. It could be some behind the bottom line. It could be some invested in the investments we'll have to make in order to give access to the savings, both in ZBB and in the new functional models. So we expect to manage a lot of moving parts, but look at the totality of our delivery and have our overall operating margin delivery just continue at the steady rate that it's been at historically. Turning to spreads, and when we expect that would bottom out. Well, the spreads market, first of all, remains very challenging. It's the same in the first quarter, really, as it was as we exited 2015, which has continued market decline in both Europe and North America. And volume declines in particular because, and we've talked a lot about this, reduced consumption of bread, reduced spreading and falling butter prices. And what that means in terms of our own performance is still mid-single-digit declines, which are mostly driven by volume. I should say that it's important when we think about our foods performance that's incorporated in the 1.9% that was delivered by foods in the quarter. Our savoury business and our dressings business have had a very strong quarter. And so, not to unpick things too much, but I think it's important to recognise the strength of performance within foods if we think beyond spreads. Otherwise, with spreads, we're continuing to pursue the strategy. I was spending quite a lot of time with Nicolas, and actually we've had a very strong baton pass from Sean, focusing on the brands and the strategy for the business, to Nicolas focusing on the operational execution now of those plans, and that's the phase that we're at the moment as we go forward. As you know, the business continues to have very strong margin contribution to Unilever. It generates a lot of cash, and most fundamentally, what we're focused on doing is executing the plans and preserving the value of the cash that the business generates in the interests of shareholders. That's what's on our minds.
Okay,
Thank you much.
The next question is from Javier Escalante of Consumer Edge.
Good morning, Graeme, Andrew. My question is, I was struck by the commentary about where you mentioned what it could be described as the polarization of the emerging market consumers, some of them, trading up, some of them trading down. So if you can help us understand, we thought that was something that it was mostly developed markets. So if you can help us understand which countries you are seeing this, or in which categories this polarization is taking place. Are you seeing, for instance, more price sensitivity, say, in food or in household products relative to personal care? If you can give us more color, understanding that the aggregate of these countries is very complex. And the other thing is that if you explain, I was a little bit confused about what is the takeaway with regards to emerging markets, because it seems to me that you are expecting some of them to get worse. So if there is any particular one-timer that somehow flattered the volume in Q1 as, say, a trade stocking in Brazil or something like that, if you can give us any sense whether the volumes in this quarter somehow were flatter and then you're expecting this stuff to roll off, or is just more macro conditions that you expect to worsen? Thank you.
Thanks, Javier. Good morning. Let me take the second one first again. No, there isn't anything I can think of that's been a one-time flattery of volume, any particular destocking, any particular channel shakeout events across the emerging markets. Generally, what we see is that those markets are more volatile. There is more polarization. I like the expression that you used at the start of the question. But we've seen this before. Perhaps we've not seen the same degree of polarization, the same degree of volatility. But we're confident that we know how to manage our way through these markets. If I take Latin America, when you take Brazil and Argentina, which are particularly acute at the moment, we know how to focus first of all on the consumer. By having local management teams who are empowered to make pricing decisions and think about consumers trading up and down within categories in those markets. We focus first on the consumer, relevance of our pricing, making sure that we're competitive. We continue to invest behind the brands. We stay in for the long term, and typically we come out stronger. You can never be entirely sure that history will repeat itself, but if you take the example of Argentina, 15 years ago, the last time there was a major devaluation event there, our business certainly came out stronger as a consequence of that philosophy of management and leadership in the market as we managed our way through the choppiness. Now, on your question about polarization and specifics, it's hard to give you a specific example on a particular country about trading up and down, but I do think that what we see in take a European marketplace of a very value-conscious consumer looking to save money, but also trade up and treat themselves, is a piece of consumer behaviour which isn't limited to the developed markets, and you see that behaviour in what we, generalising call the emerging markets. But of course, within every emerging market, there is a pocket of that market which is the same demographic as most of a developed market. So that's where you see that. Your consumers are trading up and down. The example, if I go across categories, perhaps where we see that more strongly, could be in personal care and home care, very volume-sensitive category, home care in particular. I just wanted to share with you the example of laundry in India, where I was a couple of weeks ago, and the more fundamental, because India has been less impacted, stronger economy, currency less impacted, and therefore the deflation that we've seen in a couple of categories in India is much more being a function of the commodity cycle, but more fundamentally in the laundry business in India. A brand like Surf Excel, a little bit above wheel, we're continuing to see consumers trade up from the bottom brand of wheel into a position like Surf Excel, and that, thinking more longer term, is exactly the sort of thing we expect to see and continue, and very much what our strategy is focused on.
Okay, we just have one more question from Eileen Khoo of Morgan Stanley. Eileen, please go ahead.
Good morning, gentlemen. Thanks for taking my call. I just had two follow-ups, actually. The first one is on LATAM pricing. I'm just trying to understand, your pricing here has been very strong for a number of years now. In fact, accelerated this quarter to over 15%. And I know you said, Graeme, that none of your markets are hyperinflationary, but obviously 15% is quite high, and if Brazil is 10%, and that's by far your biggest market, what are the other markets that are moving the needle for you? And how should we think about the volume pricing equation here in the coming quarters? And then the second one is just on refreshment. All the commentary is pretty positive, and you've obviously got great innovations, etc., in ice cream. But at least versus our and the market expectations, the 3.8% like-for-like seem to be below what we were expecting. Is there any particular reason there? Was it because of LATAM, summer, etc.? Is there any colour you can give around that? Thanks very much.
Hi, Eileen. Thanks for the questions. On Latin American pricing, it has been strong in Brazil and Argentina. We've talked a fair bit about the specific actions that we've taken. Markets where we lead, and markets where, again, focusing on the consumer, focusing on affordability, the combination of commodity downturn, but washed away, more than washed away by currency devaluation, has meant on-the-ground inflation, and we've had to be very consumer-centric in the way that we've taken those price increases, but we have taken a lot of price increase. Now, the contribution that Latin American pricing has had overall to Unilever hasn't really changed. Yes, it contributed most of the global pricing in 2014 and 15, and it was all of the global pricing in 2016, if you choose to just carve it out in that sense. But that hasn't really changed much over the course of the last 2 or 3 years. In terms of what we expect looking forwards from a volume perspective, in Brazil we've got negative volumes and an ever-deepening recession, and we expect that will continue. Innovations are doing quite well. We're growing penetration, we're growing distribution, and as I mentioned earlier, we're making sure that as consumers downtrade to Tier 2 and Tier 3 brands like Surf or Brianti, that they're trading down within our portfolio. Argentina, another challenging economic reset. We have seen volume growth actually in the first quarter. Continue to invest behind the brands, but we do think that consumer demand will contract in the remainder of the year. Andrew, do you want to comment on refreshment?
Yes, on refreshment, as you know, we've had a couple of good years, Eileen, with 5% plus growth. I would always say don't read too much into any one quarter, and I think that's particularly the case in a business like refreshment, which is more seasonal.
And just to flag Q3, we had a very, very strong...
So we will face a strong comparator again in Q3.
Strong comparators as we go through the balance of the year.
Okay, we'll bring the call to a close there. As ever, myself, Ansgar and Becky will be very happy to take any further questions when we get back to our desks. And so with that, I don't know, Graeme, if you want to say any concluding remarks.
Just thanks from Andrew and myself for your time today. I know it's been a busy morning for everybody. Sum up in a few words. We're on track to deliver another year of competitive top-line growth. We think that will be in the range of 3 to 5%. If we think about the momentum we have in the business, we think our business is still continuing to grow at about the 4% rate. There were a few, there was an extra trading day, there were movements in Easter, there were various things. We haven't deconstructed that. We don't think it's had a particularly major impact, but there will be some impact without doubt. We just haven't been precise with it. But we remain on track to deliver. We'll continue with steady margin improvement. I hope you've got that message. And the initiatives we're taking, we think, position us well to deliver long-term value creation into the future. And with that, I hope you enjoy the rest of your day. Thanks very much.